All right, we will call to order the February 12th meeting of the Oklahoma City Post-Employment Trust, Benefits Trust, and welcome everyone to the meeting. First item of business is the approval of the minutes from the December 11th, 2017 meeting. All in favor? Any opposed? Next is presentation of investment performance review, and Doug Anderson is here with ANCO. Welcome, Doug.
Thank you, Mr. Chairman and trustees. It's a good report. I think I want to address probably something that if you've been watching the news over the past week, what you've seen. Yeah, we did have a market correction last week. Portfolio is strong. We dipped a little bit under $50 million as of last night. Markets appear to have stabilized. We had an unusual environment last week where I was reading about one of the things that typified it was we had a spike in volatility that happened very, very quickly in stock prices. And when I see things like that, and I don't see, some macroeconomic event backing up that, I think this is probably a technical issue, algorithmic trading, et cetera. And what had happened in the market was that we had been enjoying an environment of steadily rising stock prices and very low volatility of stock prices. So it meant that prices were going up, but with very little disruption to the pattern. And so what happened is that these derivatives that were called VIX derivatives became a very, very crowded trade. People were effectively selling volatility as a way to generate returns, and when the market turned and volatility went up, the most popular instrument for selling volatility went down 96% in about 10 minutes. And so that tells me that the market was crowded, that it's not necessarily a real market event that caused this. In fact, over the weekend I was reading about one tiny hedge fund in Denver was betting the other way, betting that volatility, there was a decent chance to increase. And what they saw in their calculations that the market was pricing in the volatility that we saw as a 1 in 5,000 year event, right? Very remote possibility, when actually it's a 1 in 5 year event. That's a normal cycle, but market psychology, it just moved, we're not going to be volatile, we're not going to be volatile, we're not going to be volatile. And so they turned a $200,000 investment into $17.5 million in the course of 10 minutes. This trade had been on for years. In fact, the two chief investment officers were out for a walk when it happened. They got back, and they're like, it just went down, the contract just went down by 96%. So, okay, better lucky than good at the timing. But to me, that says that what happened in the market while it was scary last week, it was a blip, right? We do not see global economic slowdown. In fact, the global economy is in a synchronous expansionary phase, which is very unusual. The first quarter real GDP in the U.S. should be above 4%. So it's a blip. It is a market phenomenon and not an economic phenomenon. So with that opening monologue, we'll go through the report. If you look in your packet, you'll see on page 1 of our section is a nice letter from our CEO, Mike Welker, about the progress our firm is making. We continue to grow. We continue to be committed to our independent business model, and we continue to be committed very, very strongly to putting our clients first. We had one new partner named this year, and that was a long-term employee, Dan Johnson. He is a director of consulting right now. But first year we had 6 partners named. This year we had 1. I'm not eligible for a number of years, but I'm looking forward to that day myself. The firm is growing and doing very, very well. We have almost $80 billion in assets under advisement. And if you look at the next page, you'll see our organization chart, 87 employees, continues to grow. We're adding staff in what's called client services, which is back office. That's where these reports are generated. Research has grown dramatically, so these are folks who are doing primarily manager research. You'll see that group is growing each and every year. And my favorite group is operations, because they took the business of running the business off of my desk when we merged with the group in October. So you'll see we have director of HR, we have several IT people, we have programmers, controllers, director of marketing, I think the director of marketing is pretty important too. Our marketing and consulting are different. They're separate at our firm. There are other firms out there that consultants are paid to market. That's part of their job. They're sometimes paid more to market than they are to consult. But as far as consultants' compensation, it is based solely on maintaining and growing your existing book of business. So we're not paid to go out and turn up new business. We're paid to take care of our current clients. I think that's the best way to do it. So any questions about the organization? You'll notice on the lower left-hand side, compliance. We have a full-time chief compliance officer, and we have a new Sarah Searle just joined the firm January 15th, because our business is highly regulated, and there's a lot to keep track of there. So going forward with the performance, the year 2017 was one we should remember very fondly. If you look at performance, for the lower right-hand side on page 4, you can see the international equities by the reddish columns there, up anywhere between 25 and 37%. You'll see domestic equities up around 20%. Large cap outperforming small cap by a pretty significant margin. And one other thing about the equity markets on page 5 I'd like to point out is just how much growth outperformed value in the past year. You'll see at the Russell 1000 level, you had value stocks up 13.7. That's a pretty credible rate of return. That's a nice rate of return. But you'll see that the growth stocks were up 30.2. So that's a pretty significant gap, and it's highly unusual to see that in the 9th year of a recovery. Generally, growth outperforms early when you see accelerating growth from those companies, and that's what the market's paying for. But I think we've hit a bit of a plateau, and now we've accelerated to an even higher level of economic growth. So I don't want to spend a whole lot of time on market environment, but turn to page 12, if you would, please. This is the total fund rate of return for the year 2017 was 16.7%, and I think it's much better than I expected. And if I'm doing my job, this is probably above your expectations as well. 16.7% is a fantastic rate of return. And as the portfolio continues to grow, that's a bigger number. If you look on page 14, we ended the year at $51.352 million. I checked, as of the close of business on Friday, the portfolio was $49,999,275. So we're just below. We are $625 below $50 million as of Friday. And given the fact that the market's down 10% year to date, for large caps, not surprising. So nice to see that the markets have stabilized so far today and have actually moved higher. On the next few pages, you can see asset allocation, how we've been stable over time. And remember that we do take back profits from the equity portfolios as a way to maintain our allocation and our risk posture. And I'm not in the state of mind that we need to be either increasing or decreasing risk. We're pretty happy with the way returns have come in, but we all have to acknowledge that this is a long-term portfolio, and it's not something that we want to be reactive to day-to-day transactions. I talked to a client last week, and they said, well, what should we do? This is a client I've known for a long time. And I said, well, the first thing you should do in situations like this is panic, and then you start making decisions, very long-term decisions to change your portfolio in your panic state, and you should be fine. That's not what we do.
Well, what? We're behind the curve. We're not panicked yet.
Yeah. So let's make sure that we have that high emotional agitation level before we start making any long-term decisions. From Animal House, remain calm at the end of it. Yeah. It was a good movie. So as we look on page 16, we started the quarter, the fourth quarter of last year, $49 million. We ended at 51, and that was through returns. And if we look at our asset allocation on page 17 by manager, you can see that we are diversified. This is a very long-term plan. We have managers who have offsetting exposures that should perform differently at times. And if we go down to page 18, you can see the total fund for the quarter ending the financial reconciliation. Just roll it up to the very top line there, $49 million at the start. We had income of $352,000, and we had appreciation of $1.85 million during the quarter, giving us that ending market value. And most of that appreciation came from the Vanguard 500 Index Fund. It's our largest exposure, and it did well during the quarter. So following page, on page 19, you can see the returns here versus the all public plans under $70 million is the universe that we rank the total fund against. And this is net of fee returns, making it even a little bit more impressive. These are net of fee returns. For the quarter, up 4.49%, sixth percentile ranking. For the 1 year, 16.71, the 16th percentile ranking. And for the 3 years, 7.19%, in the 45th percentile. The 5 year and the 7 year reflecting some of the out years of performance, where we had different manager structure than the one we have today, and also go over the long periods of time, we had a different asset allocation where we were much more heavily into low risk, low return assets coming out of the great financial crisis. So looking down that 1 year column, we've got a lot of good comparisons here. The bond funds performing very well. Loomis sales at 7.71%, first percentile rank. Double line, 4.71, eighth percentile rank. Again, this is an area we don't want to index, is fixed income, because we think you can significantly outperform. Our high yield portfolio managed by Lord Abbott was up 9.48% in the fifth percentile. And our volatility cushion, 10.51 in the third percentile. When we come to you with the report for this month, at the end of this month, something unusual happened with Hoisington. Usually they do well when the market goes down. At this time, interest rates went higher for the first part of the week. And that traced its way back, but it was a little bit unusual, where normally this is a cushion to volatility, but last week it was actually added to volatility for some reason. So in near constant talks with Hoisington about how to think about their portfolio. They're not going to shorten duration anytime soon. They still are maintaining the 30-year maturity structure in their portfolio because they see no real changes in the data. The index funds, you can see how well they perform versus their peer universes. And then when we get into our active managers on the equity side, Hotchkiss is, they're kind of having a low spot right now. They're performing better, but this is a portfolio that can kind of take some time to lay in wait before their positions come in. Just to give you an idea of how contrary they are to the rest of their market, their largest and best performing position last year was called Banco Popular, which is Puerto Rico's largest bank. So that's really the areas that they look. They want to go to places where folks are skeptical, scared, and then buy shares very cheaply in those areas. Stevens is starting to come around nicely. Again, this is a small cap growth equity portfolio. They're investing not so much in some of the typical growth names. They've got a nice, they have a underweight to biotech because they think it's a highly risky market, and that was a cause of almost all of their underperformance last year, but they've got a nice allocation to what they would call low-risk technology, which is a lot of consumer-facing technology. They also are investing in industrials that they've done well in. And for a small-cap growth equity manager, they've got a pretty nice allocation to the defense sector within industrials, given that started in 2016 after the election. Causeway is performing well. They're up 27% last year. I had a meeting with them just a couple of weeks ago, and again, value manager, contrary manager. At the time, their largest holding was VW, and they started buying it right after Dieselgate, so that tells you how courageous they can be in some of their convictions. But that portfolio is doing very well. The other pages in this report, the individual slides, the manager write-ups, I won't say much about those. Loomis continues to do very good in their credit strategy. Double line is a little bit more cautious right now as far as the direction of interest rates, but it's a nice offsetting package of returns or portfolios there. 39 and 40 show the investment growth over the last 10 years, what's performed best in each of the categories. And then on page 41 is our correlation chart, which we like to show this because we do have some assets that have negative correlation. Column D is that Hoisington-Wasatch portfolio, and it has a negative correlation with most other assets. One of the things I like about it is it's got a negative correlation with the other assets, but it also pays a fairly good yield in today's world. So a fairly good yield for a Treasury bond is 3.1%. And if you can believe that, the United States has government interest rates that are higher than interest rates of most other governments in the world, at 3.1%. Look on the following page, on page 42, our compliance page. Stevens is on alert, happy to report that their performance is improving. I'm not sure what your thoughts are on upgrading them. If we go back to page 16, you'll see that they were in the top quartile for the last year. Kind of like to see that 3-year number improve a little bit before we move to upgrade them. But again, we're keeping a close eye on them, and they seem to be doing well. And then on page 43 is the fee summary here, where we compare the expense ratios on a weighted average basis. At the total fund level, gives you 49 basis points. The category average would be 82. So we're saving 33 basis points, or on the portfolio at its current size, $123,000. We'll be looking at this, continue to look at this throughout the year, making sure that we have the most attractive fee arrangement with all of these investment managers, because expenses are coming down. Not as much as we would like, but they are coming down in some parts of the marketplace. Our asset allocation is shown on page 44. We're within range on all of our categories here. And speaking to Bob last week, it looks like we may have some more money to invest soon, and we'll do that according to the targets that we have set for the long term. So that's the quarterly report, or that's the quarter-end report. Almost a 17% rate of return over the last year, which is fantastic. And it tells me that we need to dial back our expectations for this year. But it's very, very strange to be in this late of the stage of an economic recovery that's been this long of a duration, and to see growth actually accelerate. We had 3 quarters last year where growth was above 3%, which we haven't seen for a long time. And with the first quarter of this year potentially coming in above 4%, very unusual, but I think that there are a lot of things going into that. Happy to talk about.
Are there any questions on the quarterly report?
I got a question on the opening monologue.
Yes.
Do I take it from that you are discounting the prospects of rising interest rates and inflation? Is the case for those being overstated, do you think?
I think that we haven't. If there's one thing that I do believe, that in markets that they do overreact in the short term, in most cases, especially when we're at an inflection point. I think that rising interest rates, the Federal Reserve is watching that very carefully, right? They raised short-term interest rates twice last year. They're on track to do it 3 times this year. That tells you that they are definitely keeping an eye on inflation, which is the driver of interest rates. So I don't think that we'll see interest rates moving much higher. Right now, the way the curve is acting, the yield curve, you're seeing the 10 years and the 5 years sprint higher. You're seeing the 30-year sort of jog higher. So what that's telling me is that there might be some selling out there at the long end of the curve. But I'm also hearing from the corporate sector that long-term debt, there's not enough issued out there for a lot of the activities that insurance companies and pensions are looking for. And so they're holding rates a little bit lower at the long end. And, if the Federal Reserve, they can only affect short-term rates. So I look at the long end of the curve to see what inflation is, expectations. They've risen modestly. I mean, we're still below 3.2% yield. So is that higher than 2.8? Yes, it is. But those are both pretty low levels. The rest of the world is playing catch-up as far as growth with us right now. You're definitely, I don't know, definitely is a very strong word. You're not going to see inflation coming from energy prices. That's not going to happen. And that was a primary driver in the 70s and the 80s, right? It's just not going to happen because we have the technology to increase supply if the prices go higher. So prices on energy are going to be moderate. And I've got a whole monologue on that if you'd like. Thank you.
All right, any other questions on the quarterly report? Next item is to receive the monthly investment reports, performance reports for December 31st, 17 and January 31st of 18.
Sure, I'm not going to talk about the December report, but if you turn in your packet to a few pages past the December short report, the flash report, to the January 31, again, started off the year nicely. Looking at the market value as of January 31st, you can see $53 million. Yes, we have given some of that back. And that is not to be, we should not be shocked by that. For the one-year return at that period was 18.36. You can see some negative figures here on the bond side of the portfolio. But you can see the returns for the quarter. The Vanguard 500 index was up over 10% for the 3 months ended January. Good results elsewhere. Stevens performing well. You can see Hotchkiss had a nice quarterly return there, and Causeway up 7.16. Those one-year returns are stunningly good, if you look to the right there. So, 1 month update. We'll have the February report to you as soon as available.
All right. Any questions on the monthly reports? I would take a motion to receive the monthly reports for December 31st, 2017, January 31st, 2018.
So moved. Second.
All in favor? Any opposed? Thank you, Doug.
Thank you, Mr. Chairman.
Next item is the discussion on consideration of any changes. We don't have any changes on today. Item 6 is acceptance of the interim financial statements for the 6 months ended December 31st, 2017. And we have Jake Siebenaler here to present those financial statements.
Good morning. Thank you. We just want to highlight a couple items out of the quarterly financial report ended December 31st. So if you'll start, we'll flip over to page 2 under the management discussion and analysis. At the end of the second quarter of fiscal year 18, we reported a trust net position of $52.8 million. This is an increase of a little over $9 million from the prior fiscal year that ended at December 31st, when the net position back then was $43.8 million. In comparison to the same time period for the prior year, contributions and benefits have both decreased by about $1.1 million and $1.3 million respectively, while investment income has increased by about $2 million. For comparisons, the trust gained $3.6 million in net position through the second quarter of fiscal year 17. Next, I want to flip back to page 10 under the notes section. We'll look at our assets. At the bottom of this page, you'll see where our money markets valued currently at about $1.7 million, and this is compared to the prior fiscal year of $2.3 million, which is reported at the top of page 11. And these funds are used to pay short-term claims and benefit costs. Are there any questions I can help you with at this point?
Are there any questions on the interim financial report? Hearing none, I'd take a motion to receive the report. All in favor? Any opposed? All right, thank you. Next item is to ratify the claims listing. All in favor? Any opposed? All right, thank you. Next item is the reports and comments from trustees and staff and interested parties. We did receive notice from Frank Wanto that he's going to be stepping down from the board. And he's served, I think, since we started the board, hasn't he? And so we'll work together on a resolution.
Luther Trent was here before.
Before Frank?
For a short time.
Okay. We'll get together a resolution to just show our appreciation for his service and to appreciate his time on the board and dedication to it. And so we'll be working on that. Bob had a couple of comments on just as we're looking at a member to replace Frank, of some of the requirements that we have that are included in our trust indenture.
Yeah, Craig and I were talking a little earlier about, what do we need to do at this point in time. Like everybody else, very sorry that Frank's not able to continue with us. He's been a great trustee. We did take a quick look at the trust indenture, what the requirements are for the various trustee. Frank would be considered our trustee number 5. And Ted, you're right. Luther Trent was our initial trustee in that position. There's also reference to Municipal Code 4202. Basically, that's for any, I guess, qualifying members of these groups that are eligible for benefits, health benefits. Those are what's considered, or what's to be considered initially for somebody that would be replacing Frank. Basically, what we're seeing is that, and most of you probably remember this from our initial startup, was that trustees 4 and 5, that'd be Ted and Frank, are nominated by the mayor and appointed by council. Trustee 5, which is Frank's position, initially served, or the position initially served for 2 years, and then after that it's 4-year terms. So that's what you guys are in right now, is 4-year terms. In order to qualify for trustee 5, they would have to qualify by membership in one of the classes identified in 4202 Municipal Code. And basically what that covers is, like I said, health care benefits made available to retired employees, survivors, certain contract employees, elected officials, and disabled employees. I know that before we looked at the retirement systems and, for a representative from the retirement systems that are included with those classes. Now, there is a little tricky piece to Frank's, because his term actually was getting ready to end on June the 17th of this year. The way that the trust indenture is worded is that we would initially have a trustee appointed to fill the rest of his term. Again, since that would only be a month or so, I guess the question would come up: would we be able to have an appointee a trustee appointed for the remainder of his term plus 4 years, or would we have to come back and do an appointment for the 4 years? I'll work with Francis and Dick on that as to what we can best do. But it looks like we can go ahead and approach the mayor's office in regard to that appointment. And I think, Craig, you had talked that we may have some folks in mind that we want to have considered for that. So if you'll just kind of communicate that to me and my staff, we'll make sure that that's included in the list that goes to the mayor's office.
So, Bob, there's no term limit, is there? I mean, it's not like Ted can't continue to be reappointed for as long as he's interested.
Right, they can succeed themselves for subsequent 4-year terms.
So it wouldn't be an issue of taking up some of the term limits if we if someone was appointed by the mayor for a brief 2-month term and then again in June or whenever.
Correct.
Right.
We'll clarify all of that with legal and talk to Francis as well, and come back with hopefully appointee, by the time we get back to our next meeting, which will be in May.
Okay, great. Thank you, Bob.
You bet.
Any other comments from trustees or staff? All right, then, we are adjourned.